In episode 283, we cover 8 tips for staying invested during down markets. Keep watching. Welcome back to the Mullooly Asset Show. I'm your host, Casey Mullooly, back with you for episode 283, and we've got a good one for you this week. We're going to talk about 8 tips or 8 statistics really for staying invested in down markets. These are meant to keep you thinking long term and keep them in your back pocket if you're having doubts about your investing process, and hopefully these will keep you on track. We're going to link up to all of these where I found all of these statistics in the show notes, so don't worry about that. Be sure to go check them out. Number 1 is from Callie Cox, and that is that the S&P 500 has fallen 2%. It's fallen 2% or more 408 times. In 68% of those instances, it's also gained 2% in a single day within at least 2 weeks. So the best and the worst days in the market usually happen pretty close together, which ties in nicely with number 2. This was from Sam Rowe. He tweeted a chart, I think it was actually from Bank of America, but he tweeted a chart that looked at if you missed the 10 best days in the market, if you missed the 10 worst days in the market, and if you just stayed invested throughout that whole time. So it goes all the way back to 1930, but I just want to look at the last 2 and change decades going back to 2000. So in 2000, if you stayed invested during the whole decade, your return was negative 24%. If you missed just the 10 best days, your return was negative 62%. In 2010, if you were invested that whole decade, your return was 190%. But if you missed the 10 best days, your return was 95%. About 100% difference there. And so far this decade, in the 2020s, if you just stayed invested, your return is 33%. But if you missed the 10 best days, it was negative 24%. So big differences. Again, the best and the worst days tend to happen very close to each other. So just staying invested is usually the only way that you're going to nail a bottom is if you stay invested. So number 3, this is from Ryan Detrick, and he looked at the annual average drawdown in midterm election years, which is 17%. Right now, depending on where you look, we're down between 10 and 15%. So down 17%, very normal. Should be expected, and doesn't mean that anything is wrong. Number 4, from Quintanilla, he tweeted a chart that looked at the percent probability of the S&P 500 having a negative return over 1 day, 1 month, 1 quarter, 1 year, 3 years, 5 years, and 10 years. So the probability that the S&P 500 is going to have a negative return on 1 day, 46%. Basically a coin flip. No one really knows. Over 1 month, 38%. Still not great. Over 1 year, that percent of a negative probability goes down to 25%. So, and then at 10 years, it goes all the way down to 6%. So said another way, there's a 94% chance that the S&P 500 over a 10-year time horizon is going to have a positive return. Time is your best friend when investing. That's just a fact. Number 5, not a statistic, but if you're a younger investor in your accumulation phase, meaning you're putting money into your retirement accounts, the market falling is literally the best thing that can happen. You're buying shares of the market at lower prices, which is going to help your performance over the long term. Number 6, if you're in the decumulation phase or the withdrawal phase of your investing journey, you likely should have some money in cash or bonds, which means it's not at risk in the market. That's money that you're spending that should be taking no risk at all. which opens you up to view the stock side or the growth side of your portfolio with those longer time horizons that we talked about, 1, 3, 5, 10 years. Number 7, this was from Ben Carlson, that looked at, again, the S&P 500. The average intra-year drawdown is between 13-14% overall, but in the years that the market is down, the average return of bonds is 5%. So that speaks to the importance of diversification. Don't put all your eggs in one basket. Don't take too much risk. That's one of the biggest reasons why we see folks panic sell. It's because they're taking too much risk. If you get that right off the bat, then you can just trust that your allocation is what's best for you, and you won't need to do anything. Number 8 is the last one, and it's more of a mantra, but it's "this too shall pass." The average bear market, we're not there yet, but the average bear market lasts 9 months, so the market has gone up over time. If you have the long enough time horizon, we feel very confident that the market is going to do its thing and be of benefit to you. So 8 tips for you there. I know this was a long-winded episode. Like I said, we're going to link to all these statistics. Keep these in your back pocket, and we'll be back with you for episode 284.